Gulf War 1990, Aramco strike 2019, Russia sanctions 2022. 3 times oil spiked, 3 times investors piled into energy stocks, and 3 times the people who chased the headline trade got hurt. Iran is back in the headlines right now. Oil is moving, and I'm seeing the same thing happen again. But before you do anything with your portfolio, I want to show you what actually happened the last 3 times we were exactly here. Because the data tells a very different story than the headlines. Here's the thing about geopolitical events and markets. They create noise, a lot of it. And noise is dangerous, not because it's wrong, but because it's incomplete. When Iran strikes or threatens the Strait of Hormuz, the immediate reaction makes total sense. Roughly 20% of the world's oil flows through the strait. If it gets disrupted, supply drops, prices go up. Simple supply and demand. So the trade feels obvious. Buy oil, buy energy stocks, ride the spike. But here's what I've learned after living through multiple market cycles. And honestly, after getting this wrong myself early on, the obvious trade is almost never the right trade. Because the time it feels obvious to you, it already felt obvious to 1,000 hedge fund managers, algorithmic traders, an institutional desk who moved before the news even broke. So what do you actually do? You go back to the data. You look at what happened the last 3 times we were in this exact situation. You find the pattern, and then you position ahead of where the market is going, not where it already went. 3 case studies, real numbers, and then I'll tell you exactly how I'm thinking about my own portfolio right now. Let's go. August 2nd, 1990. Iraq invades Kuwait. Oil had somewhere in the range of $15 a barrel heading into the summer. By mid-October, prices had pushed up to roughly $40 a barrel. That's somewhere in the neighborhood of 150 to 170%, depending on exactly where you mark the starting point. And it happened in about 3 months. If you were watching the news in September 1990, the trade felt like a no-brainer. Buy oil, buy energy, the Middle East is on fire. But here's what actually happened next. The coalition forces launched Operation Desert Storm in January 1991. The conflict moved faster than most people expected. And oil, it came back down sharply, falling to roughly where it had been before the invasion, somewhere around $20 a barrel. Within a relatively short period after the war ended, many investors who bought into energy stocks near the peak of the fear, around October or November 1990, found themselves riding that trade back down rather than locking in gains. But here's the part nobody talks about. While oil was spiking and pulling back, something else was quietly happening. Defense companies, names like Lockheed, Raytheon, and General Dynamics, tended not to follow the same spike and crash pattern as oil. They moved more steadily through the conflict period, and in many cases, continued climbing well after the war ended. Why? Because a war doesn't just burn oil. It burns through equipment, weapon systems, logistics infrastructure. And the contracts to replace all of that take years to fulfill. So the lesson from 1990 isn't buy oil when the Middle East gets hot. The lesson is, the obvious commodity trade tends to be a short-term spike. The more durable opportunity was often an infrastructure that gets used up and needs replacing. Write that down. We're going to come back to it. Now, if you don't want to pick individual defense stocks, and honestly, most people shouldn't have to, there's a way to get this exposure. ITA, the iShares US Aerospace and Defense ETF. It holds a basket of the kinds of companies I just mentioned. Lockheed, Raytheon, General Dynamics, plus dozens more across the defense supply chain. So instead of betting on one company getting the contract, you own a piece of the whole sector. XAR is a slightly more equal-weighted version, which means smaller defense companies get more representation, a little more risk, a little more upside potential. If the 1990 lesson is that defense infrastructure tends to hold up better during the prolonged conflicts, these 2 ETFs are how you act on that without putting all your eggs in one basket. September 14th, 2019. Drone strikes hit Saudi Aramco's Abqaiq processing facility, the single largest oil processing plant on the planet. A significant portion of Saudi Arabia's daily oil output went offline essentially overnight. Oil spiked sharply in the days that followed. One of the larger single-day moves the oil market has seen in years. CNBC was losing its mind. Everyone was calling it a black swan event. And here's what many retail investors did: rushed into oil stocks in the days that followed. Within a matter of weeks, Saudi Arabia had restored a large portion of its production capacity. Within about a month, they were largely back to normal output. Oil gave back most of the spike, and many investors who bought into the energy stocks during that initial panic found themselves underwater not long after. But again, something else is happening underneath the surface. Cybersecurity stocks, defense technology companies, drone detection and counter-drone systems. Because the story wasn't oil got disrupted. The story was critical infrastructure just got taken out by a relatively cheap drone. And every government on the planet looked at that and thought, we need to fix this. The Aramco strike didn't just disrupt oil, it exposed a vulnerability in the global infrastructure that governments started to spend money to address. That spending took time to show up in earnings, often 12 to 18 months or more. But many of the stocks in that space started moving well before the earnings caught up. So the lesson from 2019, the commodity spike tends to be the distraction. The infrastructure vulnerability is often where the more durable opportunity sits. Sounds familiar? It should, because we saw a similar dynamic play out in 2022. If the 2019 lesson is about infrastructure vulnerability, cybersecurity, drone defense, critical systems protection, and you don't want to pick individual names, here's where to look. Hack holds companies across the cybersecurity space: network security, threat detection, infrastructure protection, exactly in the category that started getting attention after the Aramco strike. Cyber is a larger, more liquid option with similar exposure. Holds names like Palo Alto Networks, CrowdStrike, and Cisco's security division. Neither of these is an oil trade. That's the point. If the real lesson from 2019 is that infrastructure vulnerability drives spending, these are how you position for that without touching crude at all. February 24th, 2022, Russia invades Ukraine. This one was different from the first two. Not a short conflict, not a single strike, a full-scale war with sanctions that restructured global energy supply chains in a way that played out over months and years. Oil moved significantly higher in the months that followed, from somewhere around $80 a barrel heading into the conflict to roughly $120 to $130 a barrel at the peak, before pulling back. And this time, the energy trade did work for a while. Many investors who got into energy stocks early in 2022 saw meaningful gains through the summer. But as the year went on, oil pulled back considerably from its highs. Energy stocks gave back a meaningful portion of their gains. And many investors who held through the full cycle found that the round trip left them with far less than the peak suggested. But the investors who looked past the oil spike, they noticed something. Europe had built much of its energy infrastructure around Russian gas, and now it needed to replace that fast. LNG terminals, pipeline rerouting, energy independence infrastructure. Companies in the LNG export space, like Cheniere Energy being one of the more prominent examples, saw their stocks perform meaningfully better than the broader energy sector through that period, and tended to hold the gains more durably. Not because oil spiked, but the structural shift in how Europe sources energy created a demand story that extended well beyond the initial conflict headlines. The lesson from 2022: when a geopolitical event forces a structural change in how the world sources energy, infrastructure-oriented companies have tended to hold up better over time. The commodity trade can work short-term, but giving it back is a real risk. The 2022 lesson is about energy infrastructure, specifically LNG, pipelines, and energy independence build-out. If you want exposure to that structural shift without picking individual names, here are two worth knowing. MLPA holds master limited partnerships, pipeline and energy infrastructure companies that get paid on the volume of energy moving through their systems, not just the price of oil, more stable, less volatile than pure commodity plays. ENFR, similar thesis, slightly broader exposure across North American energy infrastructure, including LNG export terminals. The key difference between these and a straight oil ETF like XOP, these companies make money whether oil is at $70 or $130. They're the toll roads of the energy world. That's a very different risk profile. And for most people building a long-term portfolio, that's actually the more appropriate way to get energy exposure. Okay, 3 case studies. Let me show you the pattern. 1. Oil spikes fast and hard on the initial fear. 2. Many investors pile in at or near the top. 3. The commodity trades tend to reverse faster than most people expect. 4. The more durable opportunity was often in the infrastructure, the defense spending, or the structural shift that the conflict created. The commodity is the headline. The infrastructure tends to be the trade. And here's why this matters so much for your specific situation. If you're 35, 40, 45, and you've spent years building a portfolio, you cannot afford to chase a spike, ride it to the top, and then watch it unwind. You don't have the same recovery runway you had at 25. The math is brutal. That's why understanding the pattern matters more than reacting to the headline. Now let's talk about that right now. Iran, the Strait of Hormuz, oil spiking. What's the same as 1990, 2019, and 2022? The initial fear trade is already happening. Oil moved. Energy stocks moved. The headlines are screaming. If history is any guide, that spike has a shelf life. It could be 2 weeks. It could be 2 months. But the reversion is coming. What's different about 2026? 2 things. First, AI infrastructure. This is new. The data centers powering the AI boom run on enormous amounts of electricity. Energy demand from tech infrastructure is at an all-time high and growing. That changes the long-term demand picture for energy in a way that didn't exist in any of our 3 case studies. And here's the part that connects directly to the supply chain. TSM just approved $45 billion in capital spending. Micron's high bandwidth memory, the chip that literally makes AI function, is sold out through 2026 and potentially beyond. The companies supplying that build-out, ASML, AMAT, LRCX, are getting paid regardless of what oil does. That's a completely separate demand story running in parallel to everything happening with Iran right now. And it's one worth having on your radar. Second, the photonics and defense technology overlap. Modern warfare, drones, targeting systems, communications, runs on the same optical technology that AI data center needs. Companies like Lumentum, Coherent, and Viavi are down from their recent highs, but they supply both defense systems and AI infrastructure. That's the 2026 version of the infrastructure trade. Not oil, not crude. Now, here's the honest truth about photonics. There isn't a pure play photonics ETF yet. The space is still too niche for that. But there are 2 ways to get broad exposure to the AI infrastructure and defense technology overlap. IGV, the iShares Expanded Tech Software Sector ETF, gives you exposure to the broader technology infrastructure build-out, including companies supplying the AI data center boom. ROKT, the SPDR S&P Kensho Final Frontiers ETF, holds companies across space, defense technology, and advanced communications, which overlaps significantly with the photonics and optical technology space. These aren't perfect proxies for Lumentum, Coherent, or Viavi specifically, but if you want diversified exposure to the defense meets AI infrastructure theme without concentrating in 3 small cap names, these give you a starting point. As always, do your own research and size these appropriately. And here's something that didn't exist in 1990, 2019, or 2022. AI data centers are hungry, enormously, almost absurdly hungry for power. A single ChatGPT query is estimated to use roughly 10 times the electricity of a Google search. Multiply that by billions of daily queries. Now multiply that by every AI model being built and deployed right now. The US power grid was not built for this. And that creates a structural energy demand story that has nothing to do with Iran, nothing to do with oil prices, and everything to do with where the world is going over the next decade. So while everyone is watching crude, the smarter question is, who powers the AI boom? The answer is likely nuclear and natural gas. Now, I want to be straight with you here, because this is important. These are not cheap stocks right now. Some of these names have already had significant runs. The market has started pricing in the AI power demand story. So I'm not telling you to buy these tomorrow morning. I'm telling you to put them on your watch list, understand the thesis, and wait for the right entry. Because the structural demand story appears real and multi-year, but buying at the wrong price is still the wrong move. Here's how I'm thinking about them in two tiers. Tier 1, infrastructure and cash flow plays. Energy transfer. Already in this video as an oil infrastructure play, but here's what most people miss. ET moves enormous volumes of natural gas through its pipeline network. As AI data centers drive natural gas demand higher, ET gets paid on every unit that flows through. It's the toll road of the energy transition. Pays a solid distribution while you wait. LNG, Cheniere Energy. Already mentioned in our Russia 2022 case study, among the largest LNG exporters in the US. As Europe and Asia compete for natural gas supply, partly driven by AI power demand, Cheniere is one of the more direct beneficiaries. EQT Corporation, among the largest natural gas producers in the US. If AI drives a sustained increase in natural gas demand and prices, EQT has the production scale to potentially benefit. More tied to commodity price than ET or LNG, so slightly more volatile. But the demand thesis is worth watching. Tier 2, but stretched valuations. Right story, but I need the right price. VST, Vistra Energy, nuclear natural gas power generation with data center contracts already in place. The thesis is straightforward. They sell power to the buildings running AI. But this stock has had an enormous run. It appears priced for a lot of the good news already. A meaningful pullback would make this significantly more interesting to look at. BE, Bloom Energy, fuel cell technology for data center power, a more direct AI infrastructure play with a differentiated technology angle, has had a strong run, but not as extreme as Vistra. Worth watching if it pulls back to more reasonable levels. Oklo, Aurora Nuclear. This one I want to flag separately because it is the most speculative name on this entire list. Oklo is working to build small modular reactors, next-generation nuclear technology that could potentially be a meaningful solution for powering data centers at scale. The long-term story is genuinely interesting, but Oklo is pre-revenue. It has not built a single commercial reactor yet. It is essentially a bet on a technology and a team, not a business with proven earnings. If you size this and treat it like a venture bet, this is not a core holding. It is a small, speculative position for people who understand they could lose most of it. The through line across both tiers is the same thesis. AI needs power, a lot of it. The grid is struggling to keep up. Nuclear and natural gas appear to be among the most realistic solutions at scale. And the companies building, moving, and generating that power are positioned for what looks like a multi-year demand story, regardless of what happens with Iran next week. That's not a trade, that's a structural shift. And structural shifts are where patient investors tend to build real wealth. If you want exposure to the AI power demand story without picking individual names, and given some of these valuations, that's a completely reasonable call. Here are two ETFs worth knowing. URNM, the Sprott Uranium Miners ETF, holds a basket of uranium miners and nuclear-related companies. If nuclear power becomes a primary solution for AI data center demand, uranium supply could become a meaningful bottleneck. This ETF gives you broad exposure to that thesis without concentrating in one name. FCG, the First Trust Natural Gas ETF, holds natural gas producers and pipeline companies. Overlaps with EQT and ET, but spreads the risk across the broader sector. Same caveat as the individual names, these are watchlist items, not buy signals today. The thesis is worth watching. The valuations need monitoring. Size appropriately and don't chase. Okay, let me bring this all together. Here's the full watch list, organized by thesis, not by hype. For oil exposure, keep it in infrastructure, not pure commodity. Energy transfer, pipeline infrastructure, paid on volume, not price. ConocoPhillips, COP, strong balance sheet, disciplined capital allocation. XOP if you want a broad sector exposure without picking individual names. For defense and cybersecurity infrastructure, ITA or XAR for defense, hack or cyber for cybersecurity. For photonics, the AI and defense overlap, Lumentum, Light, Coherent, COHR, VIAV, VIAV, IGV or ROKT if you want ETF exposure to the broader theme. For AI supply chain, TSN, Micron, ASML, AMAT, LRCX, the companies getting paid to build the infrastructure regardless of what oil does. For the energy compute nexus, Tier 1, ET, LNG, EQT, Tier 2, VST, BE, and Oklo, URNM, and FCG for ETF exposure to the nuclear and natural gas thesis. Here's the thing I want you to take away from this. I'm not telling you oil is a bad trade. I'm not telling you to ignore Iran. I'm telling you that every single time we've been in this general situation, 1990, 2019, 2022, the investors who tended to make lasting money weren't the ones who reacted fastest to the headline. They were the ones who looked past the spike, found a structural shift, and positioned into infrastructure that the conflict created demand for. The commodity trade is loud. The infrastructure trade is quiet. Quiet is usually where the money is. I built my portfolio to be work optional by 40, not by being the smartest person in the room, by being the most patient person in the room. By not chasing the obvious trade, by doing the work when everyone else is reacting to headlines. If you want my full geopolitical risk watch list, the specific companies and ETFs I'm watching across oil, defense, photonics, AI supply chain, and the energy compute nexus, with the price levels, comment lists below and I'll send you the free watch list. And if this breakdown was useful, subscribe, because I'm going to be tracking how this Iran situation plays out in real time. Every step, every catalyst, and what it means for your portfolio at each one. I'll see you at the next catalyst.